So we're live now. Okay, everybody, we have Kevin Davey with us. He doesn't need an introduction in this presentation because he's well known. He's a champion algo trader. He's author of several books like Algo Trading Cheat Codes, Entry and Exit Confessions of a Champion Trader, as he's been a champion trader. You can learn a lot for this competition from him. And he's gonna talk about alternate trading styles, trading to win a contest, trading your own account, and trading for others, how to succeed with each approach. He's also famous with his strategy factory approach to trading. You can find it in his webpage, kjtradingsystems.com. And I'm very happy of having Kevin with us. He was suggested by one person, Jordi Capafons. I have to thank him for telling me to contact Kevin. And that's all yours. Kevin, you can start whenever you want.
All right. Well, thanks for having me. And it's nice to see, I see some familiar faces in the list of names. So it's always nice to talk to some people who I've have a relationship with. I realize that English is probably not the first language for most people at this event. So if I start talking too fast, just put in the chat box, hey, slow down, or hey, can you repeat this? Otherwise, probably what I'll do is I'll answer questions at the end. So you can type them in anytime. I probably won't get to them till the end, but be more than happy to take questions. So, as mentioned, I'm going to talk about contest particulars. I'm also going to talk about a few other things that are kind of important relative to a trading contest. And hopefully you'll enjoy it. But first, I want to start out with this little toy car and how it turned my trading around, because I think it gives you some good lessons about trading. And so this is in the US, they're called Hot Wheels cars. I don't know where you are if they're called the same thing, but they're the little cars, little boys, little girls play with them. They fit in the palm of their hand. They have wheels that actually turn, and so you can race them and do that kind of thing. So it looks real big in this picture, but that's what we're talking about, a little toy metal car. And yes, it turned my trading around. And so I'll kind of show you how that happened. It all happened starting with this book. And I don't know if any of you have read it. It's called You Can't Lose Trading Commodities. That in itself should be a warning. When there's a book that sounds too good to be true, you can't lose. Chances are what you might find is kind of suspect. But this is an older book. This is at least 20 or 30 years or more old. But I got it at one point, and I decided to implement what it does. And the whole idea of the book is you find markets that have low prices. So they're at a yearly low, or a 5-year low, or 10-year low. And the idea is eventually the market fundamentals of supply and demand will eventually correct that. Okay. There's a saying, the cure for a low price is a low price, meaning prices won't stay low forever because more people will buy it, whatever it is, at a low price. And then as the demand picks up, there'll be less supply. It's typical, just standard economics, right? Now, this approach does something that they call scale trading. And what you do is the price keeps going down, you buy at certain intervals on the way down, and then you'll sell at a higher price. And the price will recover. So it'll go down, you'll buy a few things, a few contracts or whatever. And as the price goes up, you will sell for small profits. Sounds pretty easy. And the basic idea is, okay, so I'll give you an example. This is with the euro. And as you know, towards the end of last year, the euro hit at least a 10-year low. It was probably more than that, but I just drew some lines in of when it hit that low. It broke the 2017 low, and you could buy at all these levels. And then what you would do as it went back up is you would sell at higher levels. So you're buying on the way down and selling on the way up. Pretty simple. And then at some point, you'd be out completely. So this isn't something you would do necessarily every day in every market. You have to have certain conditions. But in this case, it would have worked out pretty well. Okay. Of course, that's not the story I'm telling today. And that's what brings this toy car into it. This scale trading approach works really well when the markets recover quickly, just like I showed you with the Euro USD. Towards the end of last year, it dropped and then it went right up. So that was the easy one. This approach is very painful when that doesn't happen. And that's where the toy car comes into play. So I did this a number of years ago, and this is more than 20 years ago, but this was a huge part of my development as a trader. That top line was where I started buying, and every line down, I added more size. So you can see I bought again and again and again and kept going. And the market didn't care. It just kept going down. And what ended up happening was every penny drop in wheat was costing me around $1,000 in real money. So, I mean, it was bad. It wasn't $1,000 up at the top, but towards the bottom, that's what it was costing me. So I was underwater, negative by a huge amount. And what ended up happening was I had to add to my account because I was running out of money. And what I would have to do at lunch, this is when I was in the working world, I was working in aerospace. I had to run at lunch over to the bank to wire more money into my account because I was certain that wheat was going to start turning around. How long could it keep going down? That's what I thought. And so to me, it was, well, it's going to turn around. I just have to stay in. And so I had to wire money into my account. And this wasn't an actual photo of the wire transfer lady, but it was pretty close. And her name was Cookie. And Cookie was great. She'd help me. This is back in the days before you could do it on the internet. She helped me wire money into my brokerage account once or twice a week. It was crazy. Okay. And we actually became good friends because I saw her so much. And I think about it now and I'm like, what was I doing? here I'm becoming friendly with somebody who is just transferring money into this losing wheat position. And that's where the car comes into play, because I actually started bringing gifts for her grandson. She had a picture of her grandson on her desk, and he was a little kid, 5 years old or something. So I bought him a toy car, or I had a toy car, and I brought it to him. And I thought nothing of it. Oh, I'm just being friendly with the wire lady. And then at some point it dawned on me, I'm like, what am I doing? I'm losing money like money was going out of style. I mean, I'm just throwing it away on this awful wheat trade that I'm so negative. And here, my solution is to buy a toy car for the wire transfer lady to make her happy and make her grandson happy. And when it finally dawned on me what I was doing, that was my big WTH, or what the heck moment, where I said, what am I doing? I'm doing something, probably multiple things wrong. I've got to change. And when you look at it that way, that toy car saved my trading, because goodness knows where I would have ended up had I not had that revelation of, like, a smack in the face. What are you doing? Stop. That toy car saved me, because then it put me on the track to algo trading. Okay. I realized what I was doing wasn't very good. I needed a structured approach to how I was trading, how I was developing systems, how I was testing systems. And that approach had to make sense to my mind. I'm a numbers guy. Probably most of you are too. The scale trading was something that sounded good, but when you really analyze it, it doesn't really make a lot of sense. There's just too much risk to it. And I realized I had to find something that was sensible, tradable, and repeatable. And for me, that was algo trading. Now, back then, they didn't call it algo trading. They called it systematic trading, mechanical trading. But today, it sounds neat to call it algo trading. It's just rules to buy, rules to sell. You computerize it, you back test it. That's algo trading. And that's where I ended up. I realized I had to do something different. And this is what I decided to do. And I've been doing it ever since. So that's what we're going to kind of talk about from here on out. We're going to talk about some pitfalls with algo trading. And we're also going to talk about trading styles. And I'll tell you what that means as we go through it. So in the next, I want to say hour, 15 minutes or so, I'm going to go over first some common algo mistakes that people make and pitfalls. So anyone involved in this competition, this trading competition, make sure you avoid these. Then we'll talk about, well, hey, what if I wasn't doing a competition? What if I was trying to manage money for other people? What if I was trying to trade my own account to different criteria? How do I do that? How do I think about those kind of things? And then finally, we'll wrap it up the last 15, 20, 30 minutes, whatever it is. We'll talk about, we'll just do questions and answers. Okay. So first, You've seen this US government disclaimer. Don't trade with money you can't afford to lose. Past performance is not indicative of future results. Treat all results as hypothetical. Great disclaimer. Usually these disclaimers are like, oh, these are so bad. This is actually a really good one. So a lot of truth in it. Okay, just so you guys know where I am right now, I am at the blue dot that you see right there in Ohio, in the United States, outside of Cleveland, which is on the shores of Lake Erie. So right now it's winter time for us. So a couple days ago, that photo in the bottom with the snow, that was us. 32 Fahrenheit, which is roughly 0 Celsius, or it is 0 Celsius. And this upper picture I took yesterday, the lake hasn't frozen really much this year. It's been kind of a warm winter, but there were little icebergs floating in the water. But that's where I am. So hopefully where you are, it's a little bit nicer as far as warmer. But you know, if you like skiing and sledding, this is a great place to be right now. Okay, so let's say you're planning a trip. Okay, what do? Well, nowadays you go to your phone and you go to Google Maps or Apple Maps or whatever, and you plot out where you're going, right? It's the same thing with trading. If you want to do a certain type of trading, if you want to win a competition, you've got to plan all this out. Hey, what do I want to achieve? I want to win a competition, or I want to get a good return for my clients. You need to plan all that, and you also need to plan for traps, for pitfalls, for bad things, and you have to expect them and be able to plan around them. And so this turns out to be a really important part of trading, is just the whole plan. You got to have goals for what you're doing, and then you've got to have steps to reach those goals. And then finally, of course, you need to watch out for these pitfalls. Okay. This might seem kind of straightforward, but I can tell you most people do not do this. Most people trading do not have goals. They just want to become rich. I mean, and that's not really a good goal. You got to be more specific about it. And they certainly don't have steps to realize that goal. You know, hey, I'm just going to start trading. It's amazing. Just because you can open an account doesn't mean you're going to be successful. You need to have specific steps, and you need to put those in place to actually make it happen. And then, of course, most people who are algo trading do things wrong. They make mistakes.
Order filled.
And a lot of the mistakes I'm going to talk about today are pretty common. So you got to have all this before you can trade your own account or trade a competition. You got to have that goal and an approach. So just as a kind of story about what I did. So I finished 3 years in a row in a contest, either first or second place. It was a real money contest. It was a year long, and you know, obviously actual trading. And so what I did before I entered the contest, I went back, and I think I actually even talked to the broker involved and said, okay, well, in years past, the top 3 finishers, what kind of returns did they get? This was a contest that was solely based on annual return. There was no risk adjustment like the competition you guys are doing. So it was pure return on account. Okay. So I got a list of what all those recent people, how good they did. And I came to the conclusion that, hey, if I get around 100% return, I probably will finish in the top 3. You never know, but that could be. And that was my goal. My goal became, hey, design a system or a strategy or strategies, algo strategies that together will give you 100% return. Okay, so I went from goals, and then I said, now I have to come up with the approach to do that. And that's building the system, picking the markets and all that other stuff. And at the same time, watching out for number 3, the pitfalls. And I was able to do that. But, when you look at goals, here's just some of them. You could trade your own account to get rich quick. You could say, man, I'm just going for broke. You could say, hey, I want to trade my own account to trade for a living. And then your risk is going to be different. You could run a fund, trade for others. You could offer signals. You could be a professional money manager. And then, of course, you can look to win a contest like you all are looking. For those of you participating in the competition, that's what you're looking to do. And each of these goals, and I'll show you later, you're going to have a different approach to it. It's not going to be the same money management and strategies to do trading your own account to get rich quick as it would be to winning a contest. And I can tell you from my contest experience that if I had to do a risk-adjusted return rather than just pure return, I would have done things completely differently. But that's part of doing this, is you got to know the rules and then just work to the rules. Okay, so let's just talk about some of the pitfalls. And as I mentioned before, pitfall number 1 is pretty easy. Most traders don't have goals. So, hey, I'm going to enter this competition and let's just see how I do. And they don't even think, well, I think I want to finish in the top 3, or I want a certain return. Most people don't even think that way. In my process, which is a trademark process I call the strategy factory, I actually have, these are all the steps I go through to build a strategy. And you can see that the top one, the first one, is you got to have goals and objectives. That's where it all starts. And whatever those goals are, they're going to be different for everybody and different depending on what you do and how you want to trade. But the important thing is you have those goals. That's a biggie. Okay. And it could be things like what kind of markets you're going to trade, what kind of time frames, what kind of style. Are you going to do swing trading? You're going to do intraday trading? And it could include the performance. Obviously for a contest where Kalmar ratio is important, well, that's going to be the performance measurement you settle on. And you're going to build strategies to that. Now, hopefully this all sounds kind of straightforward and you're like, well, yeah, this makes sense. That's good. If you think that way and you're like, this isn't really that impressive of information, that's good, because that means you already realize how important this is. And in my experience, just talking to lots of traders, I would say probably 75% of them do not do this step. They do not have goals and objectives written down or specific. They just have goals like, oh, I want to make money trading. So if you feel this is just common sense, you're already halfway there. So congratulations on that. So that's your first pitfall. Second pitfall is really, really, really important for building algos. There's a lot of software out there, trading software. I use TradeStation. A lot of people use NinjaTrader, MultiCharts, TradeView, Pro Realtime. The list goes on and on. Trade Navigator. There's all sorts of good tools. The problem with most of it is it doesn't tell you how to develop an algo. What it does is it kind of shows you, hey, take a chart, insert a strategy, maybe do some optimization, and then take the best result, start trading it. That's what is the process that they kind of encourage, or at least that they condone. It's not the process you want to use. It's a lot more complicated than that. So most people, if they have a process, they have the wrong one. But most people don't even have it in the first place. And somebody I admire very much once said, if you don't have a solid approach to strategy building, you'll never achieve your trading goals. And you know what? That's 100% true. And of course I'd say that, right? But you have to have a good approach to building strategies, because if you can't build a good algo, you're never going to reach any of your goals. And like I said, here's how most people do it. They take all their parameters, all their ranges, all their rules, combine it with all their historical data, and throw it into the software, what I call the optimization engine. And then they'll run thousands of cases or millions of cases or even billions. I mean, I've seen people who literally say things like, hey, I need a faster computer because I tried doing this strategy and it runs all weekend, still doesn't finish. What can I do? They just complicate it to death. They get the best parameters and they start trading. If you've ever done this, I know I used to. It's wrong. It's just wrong. That's the easiest way to say it. Don't do this. And again, the process I use is a lot different, where yes, we do some optimization, but we don't do a whole lot. We try to minimize the amount of optimizing we do. That works a lot better than just that brute force optimization. So that's pitfall number 2. People don't have a methodical process. And, part of that process is treating every strategy the same. And just because I gave you a strategy doesn't mean it should be tested any less than one you read in a book or found on the internet. You test them all the same, and then you can actually compare results, and then you can feel more confident, especially once you start live trading, because you say, hey, I have 10 strategies that all were developed the same way. And that's huge. And that leads to the third pitfall, which is inconsistent development. And what I mean by that is exactly what I just said. People are not consistent in how they test, because testing is hard. It is not easy to test an algo. And so what a lot of people do is they'll start out testing it and eventually realize, oh man, this is hard. I'm just going to take what I saw in this online trading forum and I'm going to use that. Or I saw this price action pattern in a book and the guy said he's successful with it, so I'm not going to test it. I'm just going to use it. That's where people get messed up. You got to be consistent in how you're building your strategies because it gives you confidence. I can't stress enough how important confidence is in this whole thing. When you do things the same way and have the same criteria for everything, for every strategy, and it works, and you see it working, then you have confidence that the next strategy you build is likely to work too. There's no guarantee, of course, but the more you do this the same way over and over, the more confidence you have. And I'll tell you what, good trading is a lot about confidence. Why? You say, well, hey, if my algo works, what's the difference? True. But every algo has drawdowns. And unfortunately, you can't start an algo and come back 6 months later and say, okay, well, I made money. No, I wish it worked like that sometimes, but the way it works is you trade that algo, but then you have to more or less watch it every day or every week. You have to see what it's the performance. You have to live through its performance, its equity curve. And when you're in drawdown, that takes away your confidence, especially if you're in one for a long time. So you absolutely need to have this confidence, and you get it by having a standardized approach. The two go hand in hand. Okay, so those first three pitfalls, those are more general. You know, they're kind of like high level. We're talking about goals and general strategy building. Okay, you need goals. You need to have a process, and you got to be consistent with the process to develop strategies. So those are all pretty big things, right? The big picture. These next four are going to be issues that algo traders have where you actually be during the contest, or you're running in the contest in the competition. These are issues that could come up that you have to watch out for. And when you combine these two together, you say, okay, I have my goals, I have my process, and I'm avoiding all these other pitfalls during the competition. You should be in pretty good shape. Obviously it doesn't mean you're going to win a competition, but you're going to put yourself in the best position possible to do well. So let's look at pitfall number 4. This one's called, in TradeStation, it's called look inside bar backtesting. Other software, it's called bar magnifier, bar resolution. Depends on your software. I'll explain what it is, why you need it. Because when you don't have it, you can go from this to nice looking strategy, right? Who wouldn't want to trade this, right? Looks good. Whoops. The real world, that's what it really will do. So you think you have something really good on the left, but the reality is what you had was on the right. And that's all because of one setting in your software, or at least most softwares, just one setting, one little change takes you from really nice to really bad. So yikes, especially if you're probably thinking, I've made equity curves like the one on the left. Well, they're bogus. And here's why. It's called, like I said, it's called look inside bar backtesting. So I'll give you an example. I'll walk you through it, hopefully slowly, and hopefully you'll understand it. So there's a simple price bar, right? Open, high, low, close. This is your signal bar. Okay, so at the close of this bar, you're going to make a decision and you're going to go long. So right around that gray line, you go long, because you're going to enter that long position at the close. Okay. I think everybody's with me so far. You'll do what a lot of people do. Put a stop at the bottom of the low of the signal bar. Okay. You'll put a profit target a little bit up. So you're going for a small profit. You have a big stop. Okay. It looks good so far, right? Now, let's say, and it, by the way, it doesn't really matter what size bar this is. It could be a 1 minute, 5 minute, 10 minute, 60 minute, daily bar, doesn't matter. Let's say that next bar looks like this. And you can see the open, high, low, and close. And during the bar, your profit target was hit and your stop would have been hit. The problem is, how do you know which one was hit first? Hopefully it makes sense. If the price in this bar opened here, maybe it went down, hit your stop, and then went to the low of the day and then went up and then came back, right? If that happened, this trade was a loser, right? Because it went down and hit your stop first. Okay. Or maybe it went up, hit the high of the day, then went down, hit the low of the day, and then it ended up at the close. Okay, maybe that's what it did. And in that case, this is a winning trade. Big difference, right? One's a winner, one's a loser. Well, which one actually happened? Well, if all you knew, or all the strategy backtester knows is, let me get a, if all it knows is, oops, sorry, I'm trying to draw here. If all it knows was the open, the high, the low, and the close, the strategy backtester has to make certain assumptions, because it says either you made money or you didn't. So it's going to make an assumption. In this particular case, it's going to assume, I won't go into the reasons why, but it's going to assume that you hit your profit target. So it would say this is a winning trade. But now reality, maybe if the price had done this, it's a losing trade. And you might say, well, there's no way the price is going to go down and then go all the way up and then come back down like that. happens all the time. Okay. And that's why you need this look inside bar backtesting, or as Fernando is saying, you must look at a lower time frame. So what you do is you have the software break this bar into, maybe it's a daily bar, you have it break it into 1 minute bars. Then you can tell what happened and which happened first. So that's all I did with the example I showed you. The one I did not have this setting enabled, and the one that lost money, I did have it enabled. So this is huge because so many people neglect this and they get erroneous results. You know, they get the one on the left when really if they went live with it, they would get the one on the right. So that's the first pitfall. Hopefully everybody's clear on that and understands it. The next pitfall, this one I see all the time too. People ignore trading costs. It's amazing how many academic papers ignore this. They do all this analysis, and somewhere in there they say, for this study, we ignored slippage and commission. And they do it. There's a lot of so-called trading gurus out there who say, oh yeah, you don't need to include that until the very end, or you don't need to include it at all, or everybody gets different slippage, so you shouldn't include it. It drives me nuts, makes me mad. That's when people do that, because this is real. This is reality. If you're going to be trading, you're going to have slippage, you're going to have commissions. It's a real cost. And I like this cartoon because trading gurus, when they're asked, do I need to include slippage? They'll tell you, don't worry about it. They'll say it's not important. You can always add it in later. Different brokers, different slippages. They'll come up with all sorts of excuses to get you to forget about how much this eats away at you. You know, a really good example of this is there's a lot of people out there who try a system, and if it doesn't work, try the reverse. Well, that doesn't work either most of the time, and it's because of slippage and commissions. Slippage and commission work against you all the time. And you really have to respect that they're going to be there and cost you money. Okay. So doing this, where you assume it doesn't matter, just totally wrong. I incorporate slippage and commission like pretty much from the beginning when I test strategies, because I really don't care if a breakout works without slippage and commission. I mean, okay, well, it might be nice to know, but that's not going to make me money, right? The only thing that makes you money is seeing what realistic trading can do. In realistic trading, slippage and commissions. And there's a few reasons why it's so important. If you do any kind of optimizing, if you had no slippage and commission, it's probably going to give you a result that has a lot of trades. That's usually the way it works. When you have slippage and commission, it's going to tell you hey, trade less. Okay. And if you think about it, think about somebody who's day trading, who's taking 10 trades a day. So right then, they have a certain amount of money that they have to make just to cover their slippage and commissions. And if they don't, and don't account for it, they think they can trade those 10 with no problems. But having that as like a fixed cost right from the start really makes you start to think, well, do I need to trade 10 times a day? So fewer trades usually are better. The second point is most strategies just don't work when costs are included. It's kind of funny. I can take a moving average, which is this classical type algo, a moving average crossover, and without slippage and commission, it works in a ton of places, ton of markets, ton of time frames. But as soon as you include those costs, it rarely, if ever, works. It's that important. And then finally, if you're looking out at the trading education world, it's much easier for these scammers to show great results when they don't show the full picture, when they don't show what the impact of slippage and commission is. Just as an example, if you're trading crude oil, this is a futures contract in Chicago on the CME. Every contract you trade, if you buy and sell, it's going to cost you roughly $30 or $35 on average. It can be a little less, but that's a good number to use to run your back test. And when you think about it for a little bit, your edge, your strategy has to make a lot more than $30 to $35 on average just to break even. And that's what makes it so tough. Makes it tough to find systems. Most systems fall apart once you include slippage and commission. Okay, let's look at pitfall number 6, because this is another one that a lot of people fall into, and it can really ruin you. Here's 2 equity curves, one on the left, one on the right. One on the left is positive, one on the right is negative. They both use limit orders. If you're not familiar with limit orders, what it means is when you say, I want to buy at $100 on a limit, you'll buy if the price hits or goes below $100. Then you're guaranteed to fill. If the price is at 101, you'll never get filled if it never goes to 100. The problem with limit orders, a lot of people think if I say I want to be filled at 100, as soon as the price touches 100, I'm filled. A lot of people think that, and that's not true at all. If the price falls to 99, then you're guaranteed and you will be filled at 100. But let's just say it hits 100 and never goes below it, you may or may not get filled. You can't assume that you will get filled. And that's the difference in these 2 charts. The one on the left assumes as soon as the price hits 100, falls to 100, just touches that price, you're filled. Of course, that helps you. That's better. The second one assumes the price has to go down to like 99, and then you're filled at 100. The one on the right is definitely more realistic. It's not perfect. I would say that the truth is, let me draw, let's just say, you say the truth is going to be somewhere between here and here, where over here it's all touch fills work. Here you got to be, the price has to be penetrated every time. Where you are realistically is probably somewhere in there, like around 80%, meaning some of the time you get this touch fill, but most of the time you do not. This is huge. And if this is something new to you, hopefully it's not, but if it is, make sure that your trading software does not assume touch fills, because that's going to mess up your back test. Okay. Yeah. Just don't do that one. Okay. Now let's go to our last pitfall that should help you with this competition. Is if you're automating, which I assume most of you are, you're going to have problems. You know, a number of years ago, this is probably 10 years ago or so, expert advisor EA bots, especially with MetaTrader 4, were all the rage. Everybody was talking about having a bot, turning it on, walking away, coming back in a week and having tons more money, you know. And you only need $500 to invest in this, and you can trade real small size, and you just set it, forget it, walk away, and come back and just collect your bags of money, right? A lot of people believed it, unfortunately. A lot of people. I always felt bad for them because, like, oh my gosh, automation is definitely useful in algo trading, but it's not the be all and end all. It's just a tool like anything else, and you still have to watch it and be wary of it. You cannot leave algos unattended. So in my own trading, what I do is, if I'm not at my computer, I'm nearby, or I have an app on my phone where I can just log into my PC where my trading software is running, and I can check my positions and I make sure everything's working right. Doesn't take long, but I do it multiple times during the day. Especially with 24-hour markets, you pretty much have to do it multiple times during the day, because you could get an order in the middle of the night, you know, and a screw up. It could cost you a lot of money. So the way to think about automation is, one, it's great to have, but two, problems can and do happen, and they will happen. Here's an example. This is my own trading, and it's embarrassing for me to bring this up, but I had an algo. I was testing it, thankfully, on the MES. This is back a couple of years ago, 2020. And you can just see all the buys and sells. It was 300 orders that my algo sent in a minute. It was every tick, it was sending orders, buy, sell. And you can see it, it was crazy. For this amount of time, it went for a couple minutes, I think, or maybe only a minute. I forget. I was responsible for like 25% of the volume in the MES because of this, because I looked at the total volume over that period, and my 300 orders, 300 fills were about a quarter of it. It was bad. And if I had not been at my computer, it would have been a lot worse. I was there and it was bad because I'm like, what's going on? You know, you don't realize it first, and then like, what do I do? What do I do? And then, okay, turn everything off. Figure it out later. It takes a little while to do. And that is something you got to watch out for. Now, there were some specific reasons why this happened. This is the only time it ever happened to me in like 15 years, 20 years. Because I was trading a one tick chart, and I just had something wrong. And it was a certain time of day. It was towards the end of the session when it kicked in. But my point is, automation, if you're going to have automation, if you haven't properly tested it, things can go wrong. You know, there was a number of years ago, there was a market making firm that rolled out a new software update, and they lost millions and millions. I forget what the number was. They were called Knight Capital, and I think eventually they just had to be bought out because they lost so much money because of automation issues. So got to be careful about that. And that's a pitfall most people don't think about. They think once I have my algo, I can just start trading and everything is great. It's not necessarily the case, so watch out for that. Okay, so wrapping up the pitfall section of what I wanted to talk about today. The big picture, got to have goals, got to have a development process, and you got to have consistent development when you're building your algos. Okay, that's everything on the left side. On the right side are more specific things that you have to make sure you account for. Make sure you have slippage and commission. Make sure you're using that look inside bar back testing, or as Fernando said, looking at the lower time frame, and make sure that your software is doing it too. Not every piece of trading software can do this properly. Make sure your limit orders are only filled if the price is penetrated. Don't fall for the touch fills. And then finally, watch out if you're going to have unattended automation. And I don't recommend it. And you'll be better off if you're monitoring it, even if it's, hey, every hour, every couple hours, whatever, I look at things. Definitely want to do that. And if you followed all 7 of these, I can pretty much guarantee you any contest, any competition, any personal trading is going to be greatly improved. For sure. I have no doubt. Okay. So, kind of plowed through those pitfalls. Let's back up a little bit. And we're talking about goals. Let's go back and let's talk about trading styles relative to goals. And what do I mean by that? Well, different people will have different trading goals, and you might have different trading goals depending on what you're trading, how you're trading. You might trade your own account, where you just want to make as much money as you can quickly. You might want to trade professionally. So that's trading your own account, but doing it 2 completely different ways. I can tell you the way I started out was probably right here. And then as I got better and learned more, I transitioned into this. But it's a different mindset. And of course, trading for others, totally different. And winning a contest, that's totally different. So all four of these things are different. I'm going to talk about each one and kind of what to do, how to think. And hopefully that'll help you as you do this. Now, because the big thing with a competition doesn't necessarily mean that you're a good trader. I'll give you a good example. When I won the trading contest that I won, it was based on percent return. Okay. So I was pretty proud of the fact I won. There's only one winner every year, right? So that's pretty good. So I sent an email to Dr. Van Tharp. He was in the Market Wizards book. You probably recognize his name. He was a pretty well-known educator. He passed away, I think last year, maybe a year before that. So I sent him, I had followed his home study courses and a lot of his teachings, and he helped me out a bunch. I didn't do everything he did. I disagreed with some of what he did, but more or less, he was sort of a mentor, but not in person. He didn't know me from Joe down the street, but I sent him this email and said, hey, just so you know, with your help, I was able to win this trading contest. And I wrote a little article about how I won it. And he has a little newsletter. And he printed it. But in the beginning, he added his little comment. And his little comment basically said, hey, this guy Kevin won a trading contest. Are you impressed? You shouldn't be, because you have to do a lot of dangerous things to win a contest. And this doesn't prove you're a good trader. It just proves you won a contest. And, think about what you really want to do to be successful. And here I was on this high. I was way up here. I was feeling so great. I won a contest. Yeah. And then he was like, big deal. Boop. I went like that. And my ego was hurting. And at first I was mad at him. Like, how dare he? He's never won a trading contest. He might not even trade. Who is he to say that he's not impressed? And I was almost going to write him back and, that kind of thing. And I said, nah. Eventually, I realized what he was talking about. And it's more or less this chart. You've got to know what you're trading to. And that's what's important. Winning the contest for me wasn't the important thing. What was important was I had a goal, and then I built a plan around it. I'm going to win a contest that's based on percent return. Now I'm going to build strategies that support that. That's what was important here. And that's what you guys have to do with your competition. And that's going to be totally different than these other things. And once you realize that, that's where you really start to learn and really start to appreciate what you're doing, because you have a goal that's tailored, or you have, I should say, you have steps that you put in place that are tailored to meet your goal. Okay. So another way to put it is, if your goal is to build profitable strategies, that's great, but the types of strategies or the best strategies you pick might be different for different types of trading. You might have a strategy that's going to build up your account really quick, or it's going to blow out. Well, you're not going to want to share that with investors, right? Because you'll have a lot of upset investors if you blow out. You have to realize there's different goals and different styles, and you've got to match them up. Okay. So for example, let's just say you were doing your own account and you wanted to get rich quick. Okay. Well, here's what I would do. I would have a strategy that probably traded pretty often because you want a lot of instances of it. And you want to be pretty aggressive, really aggressive with position sizing techniques. You want to use Kelly criterion, for example, or optimal F. If you don't know what those two things are, you could look them up. But basically, the Kelly criteria is, let's just say your wins were the same size as your losses. The formula for how much to bet is 2p minus 1, where this is your decimal percentage of winning. So let's just say your strategy won 60% of the time. So that would be 0.6 times 2 is 1.2 minus 1 equals 0.2. So it says every bet you take, every trade you take, you want to bet 20% of your equity with it. So if, depending if you have a stop loss or whatever, you set it up, and then that'll tell you how many contracts to trade. That's very aggressive, but it's intended to maximize your winnings. And actually, Kelly criteria is not the best for that. Actually, optimal F has been proven to be better. The problem with optimal F is, and optimal F again is like a percentage. It might, I won't go through the formula, but it might tell you, hey, you should risk 10% or you should risk 20%. And if you go down and look at your equity versus your winning, your bet percent. So I'm going to call, whoops, I'll just get rid of that. I'm going to call this the F value. What it looks like is something like this. It's just a cartoon, but you get the idea. This is your optimal F because it maximizes your equity. The problem is if you're a little bit off in your estimate or your calculation, you could end up way down here. You know, it's a very steep and quick curve. It's probably even steeper than I drew it. It's probably more like that, where you're just a little bit off and you're going to be betting too much. That's the problem with optimal F. But the point is, I'm picking that because I want to get rich quick. And probably what I want to do here is I want to have sort of like an intraday strategy. Maybe that trades once a day or 2 times a day, because I want a lot of little bets, you know, where I can quickly raise my size. What you don't want is you don't want a strategy that buys crude oil and holds it for a month, because you're not going to be able to change your position sizing once you're in a trade, right? You're like, oh, now I got to wait for this trade to end. Maybe the next one I'll double my size. So that's what I would recommend if you were doing a get rich quick. You're going for broke. You're just betting big, betting often, and hoping to get a quick payout. Okay. Oh, sorry. Looks like I ended here, but I haven't ended. So hang on, let me fix this. I apologize for this. Let me fix this slideshow. Yeah. You're saying, I wish it was over, but it's not. I still have more to go. So hang on. Hopefully everybody's kind of a little entertained. Sometimes these things are a little dry and I'm just like, oh, he's still talking. But that's if you're trying to get rich quick. Now, let's say you want to professionally trade your own account, meaning you want to have good risk-adjusted returns. So then what I would do is I'd build strategies that had good reward to risk, right? Because that's your goal, and long-term profitability. I'd be looking at, hey, I want a back test that's lasted 15 years and that's made money most of those years and that kind of thing. That's what you want to do here. You would avoid risky strategies. You'd avoid being overly aggressive. Again, almost a polar opposite of what the get rich quick one is. And like I said, different styles, different goals, but that's how I would do it. And so I was probably more in that get rich quick initially, but now where I fall is in this, where I'm looking for good risk-adjusted return strategies. So they don't have to make tons of money. They just have to make tons of money relative to the amount of risk, the amount of drawdown, that kind of thing. Okay. If you were trading for others, if you decide to run a hedge fund, decide to become a commodity trading advisor, you decide to sell signals to somebody, there's services that you can sell signals to. There's a lot of different ways to do this. You're aiming for steady strategies. The last thing an investor wants is a drawdown, and a big drawdown. That's what people avoid. I've offered signals to people before, and I made the mistake in the past of offering systems that had long-term nice profitability, but along the way they had drawdowns. Turns out the retail trader who's buying signals doesn't want drawdowns. They associate that with systems that are failing. So they tell you avoid risk. And what ends up happening is, I'll draw you an equity curve. So let's say this is time on the x-axis. This is your equity. What they all want to see is basically that, right? Well, of course, nobody's going to have that. So then what they want next is they expect you to go up. And then what ends up happening, let's say you have a drawdown. Most people, excuse me, most people will bail at the first significant drawdown. And of course, what ends up happening? Those people get out, your system recovers and keeps going up. And maybe it has another drawdown. It does something like this. But people will bail at each of these low points. It's uncanny how people do this. I had a friend who offered signals, and he had an indicator based on the number of subscribers, where he knew as soon as he'd have, maybe 5 or 10 subscribers here, as soon as he got to like 1 or 2, he knew that was the time to increase his position size because his system was about to turn around and start doing good. And believe it or not, he actually did this, and his performance got better because he was basically buying every low on the equity curve, and he was using the market or his subscriber psychology to do that. So that's pretty big, but when you're trading for others, however you do it, They don't want risk. So, a common thought with professional money managers is they want to get assets under management, because then they get, the yearly management fee and stuff. And then they don't want to lose too much, or very little, they don't want to lose at all, obviously. But most people who invest in those funds, if you don't make money in a given year, they'll probably be okay, as long as you don't lose a lot of money. But if you lose a lot, then they'll bail. So again, different styles, different goals. And then finally, the trading contest. What are we going to do with that? Let me make this a little bit bigger. If you haven't already, or maybe you're thinking for next year, or if you didn't do it this year, you got to design algos, or one algo, to follow the rules, whatever those rules are. So make sure you spend a lot of time. And, it sounds like what the rules this competition is using is the highest CalMAR. And then there's some interim goals of maybe profit per week or something like that. So take all that into account to build your algos. And you might say, wow, well, this isn't something that I would trade on my own. This isn't something I would have a professional trade, but that's fine. You're going for a certain type of system, and you're avoiding ones that won't help you win the contest. I mean, like my own trading, I have plenty of strategies. Probably very few of them would work well with this particular contest, but they work well with other things. And that's what people that I think sometimes don't realize is your strategies have to depend on your goals. Okay. So here's an example. This is some of my own systems. I'm putting together a portfolio of my strategies. Okay. I looked at it two different ways. One is I designed it for net profit. I want to maximize the amount of profit I'm getting out of this portfolio. And then the second approach is designing for min drawdown. So I won't share it all, but what I have is some criteria that tells me, hey, I want to pick these systems because they should lead to the best net profit, or I'm going to pick these other systems because they're going to lead to the minimum drawdown. Okay, those are two separate portfolios. And here's what it looks like. So the green is I'll move this. I don't know if you can see the camera thing, but so you can see the whole curve. You can see the green was maximizing net profit. The red was minimizing drawdown. And you end up getting two different performance curves. And it did exactly what it was supposed to. Your net profit's higher with the green one, but look at some of those drawdowns. You got this pretty big drawdown. This one's a lot smoother, but you give up profit. Now, which one would you like better? Well, hey, let's just say you're trading a contest and it's net profit based, you'd use this curve. If it was drawdown based, or maybe net profit to drawdown, you'd probably trade this one. It's a lot smoother. Again, I was able to tailor this based on the goal I had. Okay. So in your contest, your competition, what I would do, the way I would look at it, focus on the risk part. Develop algos that have low risk. And by low risk, I mean low drawdown. And they're pretty selective on their entries. They don't take every single trade. You don't need to trade 10 times a day. You're trying to go for just decent trades occasionally rather than 10 trades every day. Because I'll tell you, if you're trading 10 times every day, unless you're a market maker, you're probably just trading a bunch of noise because you probably don't have an edge that will work 10 times a day. Because the movements in a day just are not that big. And you also want to have quick recovery of drawdowns. You don't want to be stuck in a drawdown for long because that's going to affect you in this competition. So for example, this is a great strategy. This is one of my better strategies. It was developed, I'm guessing right here, but I think it was developed like back here. So everything over here is after development. It's basically real-time performance. It's made money for years. But this wouldn't be a good strategy for you guys. Look how long it was in a drawdown right here, and right here, and right here. Long and protracted drawdowns. Not fun, and certainly wouldn't help you in a contest. But if you were trading over a number of years, you wouldn't care. And if this was part of a portfolio, you can live with this strategy and doing these drawdowns. So hopefully you see what I'm talking about here with different styles for different goals. And again, I'd focus on low risk. Quick drawdown recovery, not a lot of trades necessarily, and low risk on those trades. If you can, with your competition, diversify. Diversification is the closest thing to the Holy Grail that I've ever seen. You trade an oil strategy and an uncorrelated gold strategy and an uncorrelated soybean strategy. You can get a much smoother equity curve. And that's smooth equity curve means good return to drawdown. And that's example I just gave you is right there. Aim for multiple uncorrelated markets with uncorrelated strategies. And you can measure that. You can use R squared. There's a couple different ways to do it. That's what you got to do. Okay. And when you do it, you can get this kind of thing where you go from one strategy to 6, just as an example, and you see the profits are adding and it's getting steeper and steeper, and it's kind of hard to tell here, but the curves are getting smoother. You're getting better risk-adjusted return, and that's if they're uncorrelated. So that's a biggie. You got to realize a lot of people are going to be probably saying, hey, you got to do position sizing. Position sizing, the rewards are better, but the risk is also higher. And a lot of times it's not necessarily one-to-one. So you can get by a lot of times on a risk-adjusted basis, just keeping your position size even at one contract. That might work out better for you. Don't be too aggressive, because again, this is not a total return contest. If it was a total return, I would say be aggressive with position sizing. When Larry Williams was in a trading contest, trading legend, Larry Williams. He turned 10,000 into 1.1 million. He used Kelly criteria. He was very aggressive with his position sizing. What you don't know is at one point, he was over $2 million in that account. He went from 10,000 to 2 million. Then he fell back. He actually went down to, I think, 700,000. And then he went back up and finished at 1.1 million. Wow. What a roller coaster, right? I don't know how his stomach took it, because, oh my gosh, man, I get like jittery just thinking of that kind of, he basically lost $1.4 million at one point. He still made over $1 million, but what if he had just quit it too? But my point is, with our Kalmar type contest, you don't need to be aggressive. And a lot of times it just makes your return to drawdown worse. So watch out. Okay, so if you haven't already figured out your algos and that kind of thing, look at your return to drawdown ratios. That's going to be your risk adjusted return. And that turns out to be, for my own trading, my favorite metric. That's the one I use. I actually have a spreadsheet you can get off my website, kjtradingsystems.com, that will do this Monte Carlo simulation for you. And it will tell you your return to drawdown ratio. And I use that almost every day. I think it's great. Of course, I made it. So this is what that simulator looks like. You enter in all your trades and you tell it how many trades a year and some other things. And it will tell you over on the far right, or the second column to the right, your return to drawdown. And that's what you want to try to maximize. Okay. And so that helps you. Using that tool is a nice way to help compare systems. Okay, well, which one's better? And if you've developed the system correctly and you haven't overfit it, you can actually rely on those results. Now, if you've overfit and over-optimized, you're going to get really good return to drawdowns and it's not going to be accurate. So watch out for that. All right, so let's sum it up and then we'll take questions. Hopefully you realize once you get past all those pitfalls that contests are going to have different algos, different styles of trading are going to have different algos. If you want to do well in the contest, you focus on the rules and you create algos specifically to follow those rules. And you got to remind yourself of that, because it's easy to fall in the trap of just, hey, I want to maximize net profit. Well, no, you don't. Not for this. You might for other things, but not for this. All right. So I have a lot of videos on my YouTube channel. You should check it out. Just type in Kevin Davey in YouTube and that'll lead you to my channel. And I just want to say thanks for sticking around all this time and listening to me for the last hour and a half. I appreciate it. Hopefully you've learned something. Hopefully I wasn't boring, and hopefully it wasn't just stuff you knew about. But with that, what we can do is we can turn it over to questions. If I don't answer a question today, or if you say you think of one later, feel free to send me an email. And I'm pretty good at responding to emails. I'm better if you're an actual course student of mine, of course, but I try to answer everybody's emails. And with that, I guess I'll turn it over to Eduardo. If he has a format for how he wants the questions, just type them in the chat box, or if he wants to turn microphones on, whatever you want to do.
Yes, any way is possible. So
Okay.
who wants to be first? Any question? Time for questions. Very interesting and dedicated to RoboTrader competition presentation. Thank you very much
Great.
for doing that.
It's always
Yes.
the first question that people are always scared. And then once that happens, then people.
There's the
Okay.
first question.
Okay. And this is, how do you, can you, Ober, can you
What do
pronounce that
think?
name?
Let me see the name.
Obarufet?
Is Oscar. O stands for Oscar
Okay.
Barrufet. Oscar
Okay.
Barrufet.
Okay. Well, hey, Oscar, thanks. So first he says, thanks. Okay, his question. I talked about bad habits during scale entries when the trade goes against your position. What do you think about scale in strategy? So incrementing leverage when the trade goes in favor. Okay, that's a great question. So obviously there's two different ways you can think about scaling in. One is as your position goes against you, you keep adding to it. There's people out there who will say, okay, well, you lose a certain amount, now you double your position. And you know, that's what a lot of people do. They want to get back to even. That works really well a lot of the time, except for the one time it doesn't work and you blow out your account, right? You keep adding to losers, kind of like I was doing. And if I'd gotten back to even, oh, hey, it worked out, but it didn't. It just stayed down and I had to take that big loss. So that, I don't like doing that at all, adding to losers. But now I think what you're asking is a lot more, in my mind, intelligent. You add to winners as you go along. So you're in a trend, especially if it's longer term. Okay, well, now I add to the position. I think that's a better way to do it. In the end, though, when you look at it, and I've looked at this quite a bit on a risk-adjusted basis, what the correct answer usually is don't add on to winners, don't add on to losers, just go full size right at the beginning. At the beginning of your trade, just do it. And then, you know, if the trade works in your favor, now you've had that bigger size for more of the trade. But I understand it. That's harder to do, but I'll tell you, I have a couple strategies that add to winners, and there's nothing more deflating than having a winning trade and then you double your size and then the trade retraces very quickly and you can't get out, and all of a sudden now you go back to zero or break even right away. So that's what you got to watch out for there. But great question. Next question is Carlos, and Carlos is saying, how do you assure and test decorrelation on your systems? Well, I look at a couple different things. There's correlation of the performance results. So you have strategy A, it's crude oil, strategy B, that's gold. Compare their weekly results. Okay, you could see what their correlation is, and you could see what it is over different time frames. Because one of the tricky parts about this is if you have two winning systems and both make money, just by that mere fact, they're going to be correlated, right? Because they're both going to have upward sloping equity curves, and there's going to be some correlation there. One number or one approach that I've been teaching people lately is I look at the number of negative weeks, because correlation to the upside is good, right? You want both those systems to be making money every week. And if they were perfectly correlated that way, it would mean every week crude oil makes money, gold makes money. Awesome. That's good correlation. What you don't want is every week that gold loses money, crude oil loses money. So you want to minimize what I call it, it's not the right term, but I call it like negative correlation. You want to minimize the chances of all those strategies doing bad. Okay, so that's a couple ways to do it. The other issue is just because your back tests don't have correlation and you don't show correlation doesn't mean they can't become correlated. Okay, I'll give you a real world example that really bit me big time. It was hang on, let me get a chart up here because it's worth showing you guys this. Hang on one second. Whoops. Okay, well, I'm having a little trouble here. So maybe I'm not going to be able to show you. Yeah, all right. Well, anyways, it was 2018, and I had a bunch of mini S&P and mini NASDAQ strategies, and according to my correlation measures, they were all uncorrelated. And so I thought, well, okay, I can trade a bunch of them together because they're uncorrelated, which is true. Their historical correlation was very low. But the problem was they were all stock indices, which just because they're all in the same market sector, there is just this baseline correlation that's always there, or baseline possibility of correlation, that maybe is a fair way to put it. And what happened was the market fell very quickly, and I had a bunch of strategies all say, ooh, time to go long, right as the market's falling. They all became correlated for a week, 2 weeks, whatever it was. And they all went long, and I got hammered. So just because they've never been correlated doesn't mean they can't become correlated. And that's what you got to watch out for. So hopefully I kind of explained it. So you can measure R squared of the performance results, but also take into account the fact that certain markets, if they're in the same sector, gold and silver, just realize they could become correlated, and it could be at the worst time. Okay, Alex, my friend Alex, how you doing, Alex? How do you remove a system from the portfolio? Okay, that's a good question. So the way I do it is every month I look at the performance, and since I have a bunch of strategies, I just try to pick some of the best performers. So I just have an approach that does that, and that automatically pretty much takes away ones that stop performing. So if a strategy had a bad month, it's not going to make the cut next month because it didn't do well. And you could do it based on net profit. You could do it based on drawdown, a lot of different ways to do it. The other way you can look at that, let's just say you don't necessarily have something to replace it with, like I do, where I just plug in different strategies. Maybe you're just looking at an individual strategy. When do I turn that off? When do I know it's bad? Can I turn it back on again? One way to look at that is to use the backtest historical drawdown. And if it ever hits that historical drawdown, well, hey, something's different about this strategy now. It hit its biggest drawdown ever. Turn it off. That would be a good one. You could look at the performance statistics and say, in the history of this strategy, it's never had 5 losing trades in a row. So maybe you say, when it gets to 7, I'm done. That's a legit way to do it too. So there's a lot of different approaches you could use. What I've found, I've never found one that's like, oh, you have to do this way. What I've found is the biggest thing is you have a way and you've documented it, you've written it down, you've coded it up or whatever, and you have it. And then if it happens, it's automatically done. The people who get into trouble are the ones that say, well, hey, if it hits a new low, I'm out, but it's all mental. And then when it happens, they usually are afraid to pull the trigger. So that's what you got to watch out for. Great question. Next, Ander says, how do you determine what fitness function is the most robust when you do your walk forward analysis? Or do you always use net profit? I always use net profit. And I know there's people out there, Bob Pardo, who's he invented walk forward testing. You know, he's like, only an idiot would use net profit. That's me. I'm that idiot. I've looked and I've tried other things. And when you're doing walk forward testing, which we really haven't discussed here, but if you have a fitness function that mathematically doesn't work with walk forward, which a lot of them don't, depending on the walk forward tool, you can really get weird results, or you won't even know they're like mathematically invalid. You'll get results, but you won't know. So I've looked at net profit, I've looked at drawdown, and you know what I've found is the systems with good net profit tend to have lower drawdowns. Makes sense. So a lot of times, you don't necessarily need to look at other fitness functions. There are people who spend lots of time developing their own special fitness functions. I've never found anything that was better as a whole than net profit. Doesn't mean I won't. Maybe tomorrow I'll uncover something, but as of today, that's the best one. It was funny, I was watching a YouTube video the other day of somebody else who had that same question, and their conclusion was net profit was the best. And then, as I was looking at the video, I was like, I recognize that name. Turned out he was a student of mine from like 4 or 5 years ago. So, and he came to his own conclusion. He did his own analysis, but it was kind of interesting that that happened. So yeah, I just use net profit. I keep it simple. I've had people come up with all kinds of complicated, really complicated fitness functions, and I don't know if it's that much better. And really, you would need a fitness function to be really good to justify having it. That's the way I look at it. Okay, let's see. I don't see any more questions, but we do have a little bit more time for anybody who has them.
Carlos,
Okay, how many different systems do I have in my portfolio? So I have right now, I have 175 strategies that I could trade. Now I don't trade them all because they're not balanced real well. And so what I've done last year and this year, I trade about 25 to 30. So right now I'm trading this month 32 strategies, and I've broken them up. And there's actually a video, not sure if it's coming out on my YouTube channel tomorrow or Thursday. I think it's this week, if it didn't come out last week. But I break that up into the different sectors, and there's 6 different sectors in the futures market, 6 or 7. I look at Eggs, agricultural ones, wheat, corn, soybeans, softs, coffee, cocoa, cotton, those kind of ones. Currencies, metals, energies, interest rates, and stock indices. So I have 7 sectors. I have 5 or 6 strategies in the ags, and then a varying amount in other ones with the minimum of 3. I have 3 stock indices, 3 energies. I don't know if I have 3 metals or not, but I might have 4. I have 4 metals actually. So I try to balance those. And part of it's with energies right now, they're just so crazy. I just don't want as much exposure to it. But ags and softs, I'll have more exposure. Currencies, I'll have more, because currencies really haven't done a whole lot in the last few years. So that's kind of how I'm set up. And Andrew said, I saw that video on my YouTube channel last week. So yeah, it must have come out last week. I try to put up 2 videos a week, and honestly, I kind of forget which ones I'm doing. Okay, another question from Oscar. What do you think about automating strategies in brokers with no commissions instead of regulated future brokers? I mean, brokers offer CFD. They are market makers with very narrow spreads, no commissions. Brokers have another advantage, negative balance protection. So related to your last pitfall, the worst that can happen is the maximum you can lose is the broker account, the money in your broker account. Okay, so I cannot trade CFDs in the US. They don't allow it. So that's one, just so you know where I'm coming from. You're trading against the broker, okay? Maybe most of the time that's going to work out fine, but you have to remember that the broker's in business to make money. And so how's he going to make money? It's going to be making it from traders like you. So the risk, there is definitely some what I'd call counterparty risk, that you just won a big trade. How do you know your broker's going to pay up? Maybe 100 other people had that same trade, and the broker now goes out of business and you get nothing. With regulated futures exchanges, they come together as a group, and even if one broker fails, they come and make up for it. Now, Forex is pretty similar to CFD, where that's happened before. I'll give you an example. Remember, a lot of you might not remember, but I forget what year it was that the Swiss franc for a long time was pegged to the euro, meaning its rate moved with the price of the euro. And there was a nice trade there where anytime it fell out and it got out of sync, you could make a trade because you knew the Swiss bank was going to take action to put it back to what the euro was. Worked great. A lot of people made money until the one day when the Swiss National Bank decided, nope, we're not going to have that peg anymore. We're going to let it float. And the price crashed. And I wasn't personally involved in it, but I had friends who were trading Forex, and they were told they got a certain fill, and then a day later they came back and, no, you didn't get that fill, you got this fill. And guess what? The fills were always worse. It wasn't a better fill, because the broker realized, oh my gosh, if we fill everybody with this, we're out of business. So they had to make adjustments. So you got to watch out for that. As far as that negative balance protection, whether you know it or not, somehow you're paying for that, because somebody's got to eat that cost, right? Because what's to prevent you from going to 2 brokers, different brokers, and trading crazy just opposite? You know what I mean? Because you say, well, I can't go below 0, so I'm going to position size like crazy long in this broker, and I'm going to do the same thing short, and I'm going to hope for a big price spike, and then I'll be zero on one broker and I'll make a ton of money with the other broker. Well, one, I don't know if you'd get away with that, but two, you got to watch out, because that will, somebody's going to pay for that. So that's my kind of feeling on CFDs. I know a lot of people trade them, but there's a reason the US government prevents it. And it's not because they're, bad players and oh, we don't like CFDs. They're trying to protect their citizens. So think about that. Okay, Francisco, how are you? I recognize your name. What do you think about ensemble strategies and voting systems, and what's your opinion on fitness feedback control? Okay, so ensemble strategies, voting systems, I'll talk about that. I don't know what fitness feedback control, maybe you can describe it while I'm answering the first question, or just wait. So an ensemble strategy would be like, hey, I have five, or a voting strategy, I have 5 different ways to trade the euro, and if 4 of them add up, I trade the net, so I'm gonna be long 4. That's pretty cool. And that's in effect what you do when you trade a bunch of strategies in the same market. There's a lot of funds, CTAs, who do that. They'll have let's just say a breakout strategy that'll have 10 sub strategies, where there'll be a 10 bar breakout, 20, 30, 40, 50. And then it just trades the net of all those. And that's sort of their position sizing, sort of their risk control. So yeah, if it works out, I would say go for it. The fitness feedback control, yeah, I'm not really sure what exactly you're asking. So chances are I probably don't do it. So I apologize for not knowing the details on that.
Don't worry, I don't know either.
Okay, when the strategy chooses the trades depending on the profit factor of the last 50 trades. Okay, so that would be sort of like a equity curve trading, where if the last 50 trades you've been losing money, you turn it off, kind of thing, or that sort of like that. I've called it equity curve trading. That's pretty, a lot of people like that, and I've just never, every time I've researched it, it always sounds so neat, but when I put it to the test in real time, it never works. It always seems to get out right before a strategy recovers. There was a guy in the US, Murray Ruggiero, who was an editor for Futures magazine, which was also Modern Trader magazine. And he called himself the father of equity curve trading. I didn't know that, but one time I wrote an article for that magazine saying how bad equity curve trading was. And as you can imagine, I got this pissed off Murray phone call, and he's, what do you mean it's no good? And he was basically attacking me because he couldn't argue with the logic, because hey, I tested it, I was going to live with whatever the results were. But equity curve trading, you got to watch out, especially if you do it like in an Excel spreadsheet, because I've seen it and I've done it myself, where I've made you got to reference previous cells and stuff, and it's really easy to mess up the calculation and think you have something where you don't. So I'm not a big fan of that. Oh, Carlos, thanks. He said, I very much like your conference. Thanks a lot. You are inspiration for many, many traders. I appreciate that. I'd like to say I've conquered trading and, it's no trouble, but nah, can't say that. This year, last year was really a good year for me. This year, I've already started out. I started out literally started out the first second of the trading year on January 2nd, right when the markets opened. I think the NASDAQ had gapped up 100 points. just like that, I was out of a trade and per contract lost $2,000. I mean, literally, just right when it opened. And I've been down all year ever since. So, you know, I might be inspiring, but realize I do have losses, and I think eventually I'll overcome it, but hopefully soon.
Very good. More questions? Do you optimize your strategies? And if so, how do you avoid overfitting? Or it's too long to answer?
Yeah, no, I mean, what I do is I use walk forward testing, which is a way to optimize and get out of sample results. And then a part of that is just a normal, regularly scheduled re-optimization. But it's tough. It's tough to, like I said, it goes back to goals where you, hey, my goal is this. And once you reach that goal, don't try to make your system better. People always think they have to create better and better back tests, and that leads to over optimization. I try to limit the number of iterations I do when I'm optimizing. I like to do 100 or less. I mean, there's people out there doing millions. I don't think that works. I try to limit the number of inputs that I'm optimized. I try to keep it like 4 or under. So I try to do a lot of things to really make it tougher on myself, honestly, because it's much harder to build a system with only 4 things you're optimizing and only 100 iterations than it is to build a system with 50 inputs and 1 million iterations. You can get much easier to build a good equity curve like that, but that's in backtest, and building a better backtest is not the goal. That's what people have to remember.
Good. So, questions or just we are it's almost 8
Probably a
o'clock
little
here.
burned out at this point of over everything, but that's fine. Like I said, if people have questions, they can always email me.
Right.
You know, I want to thank you for having me, and for everybody who's stuck around and listened, and I appreciate it.
Yes, thank you very much for your presentation. As Carlos said, it's an inspiration for many of us. I hope to see you maybe next year again
Okay.
with
Yeah.
another topic.
Okay. We can definitely look at doing that. And good luck to everybody in the competition, and hope everything goes well.
Okay.
All right.
Thank you very much.
All right.
You.
Thank you.
Thank you.
Goodbye.
Thank you. Goodbye. Bye-bye. I'm gonna turn off the recording.